Assalamu alaikum and welcome to the Oasis Focus on Finance show. This is the first of our 4 special Ramadan shows. And from the Oasis team, we wish you and yours a very blessed month during this very special time. In today's show, we are going to be taking a look at the South African economy and issues arising from that. During the course of the month, we'll also be taking a look at some important questions concerning your financial future and your path to financial independence. Some of these questions have been coming across our customer services desk. Should you wish to contact us, details will be up on screen during the show. As always, feedback is welcome. In today's show, we are going to take a look at the South African economy and questions arising from that. Our special guests in studio from the Oasis team are Isma-el, Ebrahim and Daniel King. Gentlemen, good day. Assalamu alaikum.
Thanks, hi.
Wa alaikum salam.
Daniel, let's start off with you. We see that South Africa's economy has been slowing down for the last 5 years, especially in terms of GDP growth. What about the next 5 years?
You're right, Shafiq. It's been relatively tough 5 years for the South African economy and the global economy in general. But in South Africa's case, we have slowed from a GDP growth rate of around 3% to an expected below 1% this year. That's on the back of a number of constraints. On the expenditure side of the economy, we've seen inflation that's been persistently above the Reserve Bank's target of 3 to 6%. That means that interest rates have been increasing over the last few years, and credit conditions, especially in the household sector, have been tightening. With household credit growing at below the rate of inflation, that tends to be quite a big drag on consumer spending across the economy. We're also seeing more recently a higher tax liability, so the tax bill in the economy will be higher this year. Although the Treasury didn't increase personal income tax rates in February in the February budget, it did leave tax brackets constant. So that's not really normal. Normally those tend to increase with the rate of inflation. This year they left them constant, and so what you might find, especially if you're towards the higher end of a certain tax bracket, that as you get your standard inflation-linked wage increase, you find yourself paying more tax this year than you did last year. Also, we saw a bit of political volatility stemming from December, and that's impacted business confidence as well. So generally, the expenditure story has been relatively constrained. In terms of output and production, one of the stories which are big this year is the agricultural sector. They're obviously being impacted by a drought. Although that's expected to be temporary, it is impacting our GDP numbers. In terms of mining, they're also being impacted by lower commodity prices, and then in the manufacturing sector as well, impacted by cheap imports of steel in particular, which is one of the big manufacturing sectors in South Africa, coming in from China. There are also some positive supply side stories. Eskom has performed a lot better than what many expected over the last year, over the last few months in particular, and there is the promise that the lights will stay on over the next year. So that's one positive supply side story to take into account as well. And then when we look past 5 years, 3, 4, 5 years and beyond, there are still a number of positive stories to tell in terms of the structural outlook for the economy. We do have a young urbanizing demographic. We also have a number of respected institutions of economic management, a very strong natural resource endowment, and something that's less spoken of, but we believe is also a competitive advantage, is our clerical staff, clerical workforce, which we believe is quite competitive, as evidenced by the global services companies, which are starting to look at South Africa as an attractive opportunity. So overall, the next year is relatively challenging. We are expecting growth of less than 1%, but over the next 5 years, over the medium term, that is expected to pick up to more normal levels, and that's pretty much in line with the consensus view at the moment.
Isma-el, now Daniel has sketched us a scene of the local situation. How much impact have global circumstances, global conditions been factoring into our economy?
If we look at the correlations between South African growth, or SA GDP, and global growth, you'll see there is a high correlation factor, and that obviously suggests that South Africa is by no means isolated from global growth. In recent times, South Africa, Daniel mentioned our resource endowment. Due to our resource endowment, we are big trade partners with the likes of China, etc. And economies like that have started moving away from the commodity-driven, infrastructure-driven economy, more to a service-oriented economy. And as a result, we have seen certain growth coming through and impacting some of our exports, etc. So we are not completely isolated from what is happening in the global sphere. However, political sort of uncertainty, political volatility does also play a role. And I would say a bigger part of our growth has been impacted by global developments. However, political developments do play a role, as well as uncertainty, regulatory uncertainty, etc. That obviously impacts the supply side. In terms of structural reforms, I think it's key that we can, having said that we are impacted by our relation to global growth, there is an element of structural reforms, policy reforms that we can implement to sort of, offset some of the global growth impacts, and that can continue. I think important for us is we've got unemployment, and if we continue with our structural reforms to address that unemployment, we can then get growth. So I think it's important from our side that we continue to address those reforms and implement that, so that while there is potentially an impact from global growth, we can sort of offset that by introducing those policies that obviously benefit us over the long term. Also, I think just to indicate the global outlook from a growth perspective is expected to be stable. Whether that is, the Chinese outlook is stable, it's in the base, everybody knows the trajectory that they're on. The same with Japan and the Eurozone, as well as the UK and the US.
Now, Daniel, a big word that crops up all the time is volatility, the temperamental nature of things, and particularly the volatile nature of the rand. Where do you see the rand going in the next few years?
Yeah, it's a common thought that the rand is actually one of the most volatile financial indicators in the world, if not the most volatile financial indicator in the world. So forecasting of the rand is extremely difficult, if not impossible. I mean, if you've got a forecast for the rand, the most likely outcome is that you're going to be wrong. That's the bottom line. It's also not really sensible to make investment decisions based purely on the outlook for the rand, because it's such a volatile indicator. That's not the way. I mean, it's not a very sensible thing to base an investment decision purely on that forecast. Having said that, a lot of the rand's recent decline can be explained by global conditions. So you are seeing a slowdown, a transition in China, which impacts the demand for commodity, which impacts commodity prices and therefore impacts the rand. But that's similar to many other emerging markets. We also saw domestic issues being priced into the rand recently. Obviously, the political volatility did have an impact there. In the more distant past, we also saw the probability of load shedding and things like that being priced into the rand as well. In the traditional sense, currently, it's pretty undisputed that the rand is quite undervalued in the purchasing power parity sense. So what that means is that, for example, if you're buying something like 2 liters of your favorite soda in South Africa, it could cost you 14 rand, 15 rand for those 2 liters. If you're buying the same thing in the United States, it could cost you $2 to $2.30 or so. So that really implies a purchasing power parity exchange rate of around 6.50 to 7 against the dollar. So that's really where your fair exchange rate theoretically should sit at the moment, and that's in line with institutions like the IMF, their own estimates. Now, we're not saying that the rand's going to go to those levels over the next 5 years. In fact, it's highly unlikely. But the point is that don't expect the rate of depreciation that we've seen over the last 2-3 years to continue into perpetuity. As global and domestic conditions change, so too will the outlook for the rand.
Isma-el, let's have a look at the fact that the rand, the value of the rand, has had a profound impact on exports and imports. We all know that. But how does this factor into price inflation?
The inflation outlook recently has certainly deteriorated on the back of a number of factors. We've seen with the rand blowing out, Daniel indicated exports, they might benefit, but on the other hand, imports become more expensive because of the rand weakening, and obviously those are priced in foreign currencies, and as a result, that inflation number or the increase in price of your imports does filter through into the economy. At the same time, we've had sort of fuel increases with your 30 cents levies that's coming through, and then also the oil price seems to have stabilized. So, while the oil price went from above 90 all the way down to below 50, almost 40, actually even below that, we're seeing now it seems to have reached some sort of a base and starting to stabilize. So you don't have that benefit of a declining oil price. And on top of that, you've got your 30 cents levies that are coming through. We've also come through a drought, which Daniel mentioned earlier. We are in the middle of a drought. So with that comes increasing maize prices because of the reduced supply. Your meat prices are expected to increase, and then at the same time, you've got your administrative expenses. Electricity is expected to increase. You've got electricity disruptions, labor disruptions, that type of thing. So yes, the inflation outlook is not favorable. However, the independence of the Reserve Bank is important. They do have an inflation target of 3 to 6%, and I think that will continue to be watched to see whether they can continue to pursue that target without any outside influence, political influence, or whatever the case may be. From a South African perspective, we are highly regarded because of the independence of our institutions and the strength of our institutions. So I think history would indicate that, the Reserve Bank could be successful in continuing to maintain that target.
Yeah, if you look at the long-term average, inflation in the country is at about 5.5%. So that really speaks to the credibility of the Reserve Bank, adding to Isma-el's point, that they are serious about keeping inflation within that band.
Daniel, back to you again. Looking at the issue of inflation and the fact that it has recently been increasing, how do we see this in terms of the Reserve Bank that we've just been discussing?
The factors that we were discussing which have led to the increase in inflation in general have really explained why the Reserve Bank's Monetary Policy Committee has already increased the repo rate, which is their policy interest rate, by 0.75% this year, 75 basis points. They need to maintain their credibility in this environment in terms of their 3 to 6% target. In the most recent meeting, they did leave the rate on hold at 7%, although 5 out of 6 of the Monetary Policy Committee members did vote to leave it on hold. One did vote for an increase of 0.25% because headline CPI inflation has moderated since February, the peak in February of 7%. But at the same time, domestic growth conditions are relatively soft. They have been revising their GDP growth forecasts a bit softer. So there's a really tough trade-off that they need to make there. Now, ultimately, the bank is not really able to say at the moment where their repo rate, their policy rate is going to end up. So the consensus at the moment is that it could average around 7.5% over the medium to long term. That implies that we're pretty close there already. We're at 7%. So that only 2 or even 1 more increase in that rate over this hiking cycle. But the bank has been at pains to emphasize that we are still in a hiking cycle. And what that means is that every time they meet in the current environment, there is a much higher probability that the rate will increase than us seeing an actual decline in that rate. So we're really looking at either a hold or an increase for the next year or so. But having said that, over the next 2 or 3 years, if global and domestic economic conditions do change, we could very well be having a different discussion over the medium term and start to think about when that rate starts to come down. And that will stimulate the economy because anyone with a mortgage is going to benefit from that.
No, absolutely. Now, another question is that in the media, there have been developments on the political stage that have really been in the spotlight. How do we understand this?
The recent political volatility has been a strong reminder that politics does have a meaningful impact on the markets and on the economy in general. The next few months we are expecting more clarity on this. So you've got obviously your local government elections, and the campaigns are well underway, and the policy implications of that are important. We also have, perhaps even more importantly, the ANC's elective conference in 2017, which really is important from a national policy perspective, and giving clarity on that. Politicians will always jockey for power, but it's our job as investment managers to look through that noise, to assess the underlying trends in the domestic economy and how that's going to impact on our clients' portfolios. And regardless of how the current scenario plays itself out, we continue to position our clients' portfolios for a strong element of downside protection. So we do that in 2 ways. Firstly, through very strong levels of diversification across a number of dimensions, and then also by including a global element in their portfolios, so that in addition to the domestic exposures, You may benefit if we see the kind of political volatility we saw in December, where the rand weakens quite rapidly. You'll actually see part of your portfolio benefit quite strongly from that.
Isma-el, I think the question that arises now is the ratings agencies, they obviously do take a look at all these developments. I think the big question is, should the ratings agencies be looking at the politics?
Agencies like S&P attribute like a 50% weight to the state of the economy and the political environment. So to that extent, the political environment can or may not have an impact on the ratings, depending on how things go. I think it's important, as I indicated earlier, the independence of South African institutions continues to be extremely important. From a ratings, or the actual rating, the credit rating, more important, that is less important. I think more important is what happens in the build-up to that. Normally, factors that they would take into account is very low growth, continued unemployment, increasing government external debt, that type of thing. And I think that's important because as those sort of indicators deteriorate, it becomes much more expensive for the South African government, South African Treasury to obtain finance globally. And when it becomes more difficult for them to finance things globally or to obtain finance, that then filters through into our economy. So then your mortgage as a man in the street would become more expensive. And so that is how it would impact everyone in their everyday life. I think it's important, given that outlook, given the potential for a downgrade, I think it's important that everybody, sort of, if there is debt that is not necessarily there, or there's no need for it, I think it's important to pay that debt down to make sure that you're not obligated or in over your head. I think that's important.
Isma-el, at Oasis, your products have been tailored for a whole range of needs. Now, taking all these complexities into account, how do you deal with all of these things we've been discussing?
I think a number of things we've highlighted throughout the discussion today has been, sort of uncertainty, political uncertainty, economic uncertainty, whether it might be the inflation outlook, interest rates, whatever the case may be. So, given that type of uncertainty, it's important to protect for the downside. And what we do at Oasis is we try and look at those companies that are capable of outperforming through the cycle, whether it's a boom cycle or a bust cycle. And how we do that is we differentiate in terms of the quality of the companies that we invest in. So we look at companies that are able to invest or that are able to generate sustainable cash flow throughout the earnings cycle. Like I said, whether it might be a boom or a bust. From that point of view, our companies tend to differentiate themselves in a more difficult economic environment. When interest rates increase, some of our companies in fact benefit from a rising interest rate environment because they've got cash on hand, and that cash that they have on their balance sheet then earns more interest income. So you actually have an alpha in terms of them having more interest income, whereas another company with significant debt on their balance sheet will be forking out more for interest payments. We've also, obviously, given the rand outlook and that type of thing, we like to diversify. So what we've done is we like to focus on those companies that benefit from exports. Daniel mentioned some of our export industries would benefit in a weaker rand environment, but also in a weaker rand environment, those of our companies that are able to deliver services much cheaper in comparison to global rates will also benefit. And then, so diversification is important, and like I indicated earlier, being able to invest in those high quality companies. So when you have an environment where volatility increases, stock picking becomes much more important, and I think this is where our stock picking skills come to the fore.
Gentlemen, thank you for that. And Isma-el, I do believe you have a special Ramadan message just for our viewers.
Yes, Shafiq. At Oasis, we'd like to wish our investors and clients a spiritually rewarding Ramadan. May the Almighty accept our du'as and prayers as well as our fast, inshallah.
I mean to that, and gentlemen, thank you very much. And that concludes our first Ramadan edition of Focus on Finance. A special thanks to our guests, Isma-el Ebrahim and Daniel King, who spoke to us about the South African economy. Stay tuned to the series in which we will address issues pertinent to you in putting you on the road to financial freedom. If you've missed this or any of our other shows, you can log into the Oasis Crescent YouTube channel. Should you wish to contact Oasis, dial 0860 100 786 or email info@oasiscrescent.com. from myself, Shafiq Morton, in the first of our special Ramadan series. Assalamu alaikum wa rahmatullah.